Welcome to the Saving with Steve show, where we talk about the ins and outs of money, pretty much everything under the sun that relates to you having a healthier, happier relationship with money. My name is Steve Sexton. I want to thank you for joining us today with our over 600,000 listeners here in the United States and over 60,000 listeners overseas. We are just so thankful for you sharing us with your friends and family and associates. Now, today we've got some wonderful guests, some wonderful information. You know what? One of the things that's been lighting up our viewers line is this statistic about divorce during the COVID era. People are trying to figure out, hey, what do I do? How do I handle this? What's the tax situation? You know what? Don't worry. We have Brent Kaspers of a Northern California law firm. And you know what? He's going to be discussing the ins and outs. One of the cool things about Brent is his subject matter is he's a CPA and he's a family law attorney. So he's going to be able to answer all those questions. What do I got to do? How do I get started? How do I minimize costs? How do I, prevent the impact or reduce the impact on my business? What if one of my employees is getting divorced? How do I deal with that? Lots of good stuff there. Hey, I'm going to be talking about estate planning 101. What are the documents you need to have? And you know what? Last but not least, we're going to get started. You know what? I just want to say this, many seniors are wondering if they had enough money to last through the retirement. And, quite frankly, they're leery of going into a retirement communities. Now it's even more so because of what's transpired with this COVID era. And so many seniors can't get long-term care insurance due to COVID. Many of these seniors may not realize that their home equity likely represents a large portion of their net worth. In fact, homeowners age 62 plus saw that their collective housing wealth increased. Understanding how to strategically and tax efficiently incorporate the wealth into a comprehensive retirement income strategy may be the key to protecting you or your relatives from prolonging their nest egg with funds that they might need for long-term care. Now, we have Steve Sless. You know what? He's been written up in Forbes and many other magazines. You see him on social media. He's here to help us out with that. So, you know what? Hey, Cameron, and Cameron's the editor. Cameron, I just did my intro. I'm going to redo the last little piece, and then we're going to kick in with Brent Kaspers in the first segment. Okay, so here we go. Okay, come on, let's get our timer going. All right. Now, this next segment is very, very significant. Why? Because of our 600,000+ listeners. We've had so many people email in because they either know a friend or a family member that when going through this COVID issue, they're going through a divorce now and they have no idea what to do. They're like a deer in the headlights. They know they need to make the transition and they don't know how to get started. And it's no surprise that, divorce is skyrocketing because, you stick two people that weren't getting along in the first place into the same room for a long period of time, they're going to not get along even further. Now, if you're considering divorce, what are the steps you need to take? How do you minimize costs? How do you handle taxes during the proceedings? And once your divorce is actually final, the cool thing here is we have Brent Kaspers. Brent's a managing partner and founder of Kaspers Luge. LLC, they have a unique skill set. Well, Brett's unique skill set is he's not only a family law attorney, he's a CPA. Now, this combination is really unique because it brings a wider range of skills to people who have high net worth, to people of regular worth. And this insight brings, big benefit to all of his clients and everybody listening today. So Brent, welcome to the show. We appreciate you being here.
Thank you, Steve. Glad to be here.
Now, I always like to ask, I don't know too many CPA attorneys, so I'm curious how you went and got started. Our viewers love to hear why would somebody get started in the profession that they're in?
It's probably going to be one of the more entertaining things I'm going to say, as far as how I backed into that. I guess I was just a glutton for punishment, and pain. Short story on this though is my mom was an accountant, so I felt like, hey, I'll get a good job out of undergrad, and I'll be an accountant. And I did that, and I realized very quickly when I started my private practice that I just did not like accounting. So I went through, got the CPA exam, and said, hey, there's got to be something else better out here. decided that I wanted to go to law school. I thought, hey, well, this will be a good, a good launch or runway here for 3 years where I can actually figure out what I want to do. And so I just kind of combined the two disciplines, got out and started practicing tax litigation for a law firm out here in San Francisco. And, realized that that was kind of boring. It was intellectually stimulating, but tax is just not, it's not great to talk to people at cocktail parties about. So I kind of wanted to get back into something where I could actually help, people. That sounds hokey to say, but I'm from a small town in Oklahoma, and I felt like, hey, look, I like the adversarial, scenario of going to court, trying to win, but I like the idea of helping people and being able to talk to them. Insurance companies that have tax problems or banks that have tax problems, they're not very fun to have a cocktail with, or talk about their issues. So that's really how I got into it. I guess it's kind of like water going down a hill, trying to find the path of least resistance. And, that's, I guess, how I ended up doing this, but quite pleased that, I backed into this.
I think it's wonderful to hear about everybody's path they take because they're all different. So it's kind of cool. Hey, if you found your superpower, that's the reason why you're on the show. So first question, somebody is considering divorce. Okay. What do they need to do to prepare? What's the big real first step that somebody should take?
I think the first thing they should say, and I'm not doing a plug here for my firm or anybody's firm. I think they should consult with a family law attorney. I think that's one thing we realized when we started our practice is a lot of the people that are considering a divorce and want the initial consultation haven't discussed it with anybody in their internal circle. And because they don't want to let the cat out of the bag. They don't want to feel like a failure. You're talking to your mom or your dad, and it's humbling. And so I think go and have a consultation, with at least one attorney to see what you're up against. Some of the things that attorney will tell you is, hey, look, it's a methodical process. Statutorily, there's a lot of hurdles and roadblocks, as far as disclosures and things like that. So nothing's going to happen fast. The cheese isn't going to slide off the cracker. The other side's not going to run away with the money and leave you high and dry. It's going to be methodical. The keys really are sort of trying to keep things as amicable as possible. That's tough to do. And trying to mitigate drama and keeping the emotions in check. And those are hard to do. Depending on the facts, whether there are kids involved, whether there's, cheating involved, all of those things sort of contribute. And biggest thing is to try to compartmentalize and keep your life on track. Don't pick up bad habits such as drinking or drugs, which are, easy for people to do that are going through a low patch. And that's really what I tell people. And people step back usually in this consultation and they're like, come on, what's the secret sauce? What do I do? Do I, hide money? Do I move money? You really got to play with your cards face up. Best part is, the best thing that I can recommend is try to keep things amicable as much as possible and, try to keep the emotions low.
Okay. So if somebody's talking to an attorney, what type of questions should they be asking?
Well, they should be asking, how big is the practice? How many attorneys are here? Do they have paralegals? We've run into plenty of opposing counsels that are sole practitioners that are great attorneys. They just don't have the bandwidth to deal with very many cases. So it's hard to get them on the phone. So you want somebody that you can contact, whether it be, the assistant, the paralegal. So one, is it a reasonably decent sized firm? Two, do they have some sort of financial, expertise, some knowledge about finances? A lot of lawyers go through law school because they weren't good at math. And, that's kind of a big factor when you're talking about dividing assets in a family law matter. They may know the law, but they may struggle with that component of it. So if it's a complicated case where you're talking about a closely held family business, you're going to have to involve forensic accountants. And this person may not have the abilities to utilize that. So I think those are the questions to ask straight away. I think, do they practice in this, jurisdiction where the case is? Because there's family law attorneys all over California. I think it's good to have someone that, knows the court system in the county that you're practicing in.
So we have about 30 seconds real quick before you have to go to
Sure.
break. How important it is to know the court system in the jurisdiction?
I think depending if it's a like Los Angeles County, I don't think it's as big of a deal. If you're talking about Napa County, I think it's a bigger deal because, people know each other there. The judges know the attorneys that are practicing. So I think it sort of depends on the population size.
Okay, great. Hey, everybody, look, we're going to take a quick break. We're going to be back with more Brent Kaspers here in just one moment. So stick with us. We're going to be right back. You're going to love this break. It's all of 20 seconds.
Good.
Hey, Cameron, we just finished segment number 1 with Brent Kaspers. And Brent, am I pronouncing your name properly?
Brent Kaspar. I don't know if you have an S on it. Are you saying Kaspars?
Kaspers.
Kaspar. Yeah.
Kaspar. Okay.
Yeah.
And your partner, Lugay?
Lugay.
Lugay.
But you're in good company there. Everyone pronounces it Lugay.
Well, I like to get it right. Okay. So, okay, Cameron, we're going to be moving to the segment number 2. And here we go. Hey, welcome back to the Saving with Steve show, where we talk about the ins and outs of money. If you'd like to go check out all the replays, you can go to www.savingwithsteve.us. If you're enjoying the stories of helpful information and insight on Saving with Steve, you can always go to our website at savingwithsteve.us. I also encourage you to subscribe to our YouTube channel, our Spotify channel, our Google Play. And hey, check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, and more. All these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal and financial freedom. So if you'd like to join us on Facebook, you can always go to the savingwithsteve.us. And if you have questions, like the questions that I'm going to be asking Brent right now have come from viewers at savingwithsteve.us. And you know what? People are going to get their questions answered. All you got to do is go to that website or that email at viewers@savingwithsteve.us and ask your question. We'll find you a subject matter expert. Okay. So Brent, welcome back to the show. Thank you for being here.
Thanks, Steve. Good to be here again.
Now, biggest question is costs. How does somebody go about minimizing fees during a divorce?
Yeah, there's a couple components to this. It's hard to do. It's hard to control the other side and what the cost could be, because you're sort of bound at the hip. Even though you're going through the divorce, you're dividing assets. The costs are a function of really how well the parties can work together to come to an agreement. The quicker the parties can come to an agreement, the cheaper it's going to be. There's less work for the attorneys. If the attorneys are drug into a trial, you can imagine there's a lot more billable work for the attorneys. So you can't control everything. Unilaterally, what you can control, though, is when the attorney reaches out to you, make sure you're providing quick responses and accurate responses. We have clients that I have to reach out to 4 or 5 times, and I charge them for each time I try to talk to them. And so that's the way you can unilaterally control your costs. But the frustrating thing is, if the other side is being contentious, it's hard to be able to control everything.
Okay, yeah, I get it. There's a lot of emotion in there, and then emotion plus money.
That's right.
So, okay, now understanding taxes, you know what, you're still married, you're going through a divorce. How should somebody be looking at the taxes? And the next question that follows that is, hey, the divorce is final now. You know what should you be paying attention to when it comes to the taxes? So I'm putting you on the CPA hat here.
Yeah, no, that's fine. So there's really only a couple of ways you can file taxes during the pendency of a divorce. And, I'll start by saying, the pendency of a divorce can be anywhere from 6 months to, 15 years. So you could be going through that process for a while. So you can file married filing separately or married filing jointly. Those are your 2 options. Typically, parties during a marriage that's going well, they'll file married filing jointly because you get better tax deductions and, better tax benefit by doing that. Now, what I tell clients when they're going through a divorce is, hey, are you concerned about the other side's, how are they running a closely held business? Are they being overly aggressive on deductions, things where the IRS could come back into the picture and audit them and say, hey, you know what, you were wrong on your taxes, you owe us penalties and interest. If that's the case, if you're concerned about that, then I would highly recommend filing married filing separately during the pendency of the divorce, because you're jointly and severally liable for taxes if you file married filing jointly. So if you're concerned about that, file married filing separately and you're out of the clear, or you're in the clear. Now, when the divorce is done, you don't have the option. You're either single, head of household, you don't have the option to file married anymore. So it's sort of, that's your cards are dealt to you there. Now, what I would recommend, a lot of people have the concern that, one of the spouses is the financial, provider for the unit, and they make all the decisions, who the CPA is, who the investment bankers are, those kinds of things. So when you get divorced, you might look into getting your own CPA, splitting it up and going a different direction. And I think a lot of people do that anyways, just intuitively, but that's, kind of what I recommend. Get a different professional service provider, and that, you're not, you don't have your old CPA looking over your books and your ex-husband's or your ex-wife's books.
That's great, because I've dealt with a few clients who've been through divorce, and they did keep the CPA or the attorney. And after a period of time, they just brought themselves to the realization they felt like somebody was looking over their shoulder, because they knew their husband was with that firm, or their ex-husband was with that firm. So they just felt more comfortable moving on. So,
Well, the truth be told, I mean, CPAs have their own ethical, governing bodies that they have to deal with too. So I don't really think you're going to be taken for a ride, or you're going to be, sold up
oh, I agree with
without
that.
a paddle. But, it just, a lot of people feel like they feel empowered actually to be able to go out and, pick a person that maybe their spouse wouldn't allow them to do it because the spouse was making all the decisions.
Mhm.
And, I think it can be cathartic in a certain way, but yeah, I wouldn't be, overly worried about it, but those are things that people do look at and consider.
Yeah, as a financial consultant, no, I wouldn't be worried about it, but sometimes it's the emotion side of things that's talking.
Sure.
So
That's
now,
right.
okay, so how to prevent your divorce from impacting your family business? This is a big question, because we have a lot of female business owners on that are listeners, and you know what, this is one of the ones that really came through the line a few times in many different forms.
Well, I could talk about this for an hour, so I'll try to boil this down. All right. So
We have a little less time than an hour.
right. So if you have a business before the marriage, then the equity in that business at the time of the marriage is separate property in California. Now, hopefully this is, I don't know where the viewers are viewing from, but I really can only really speak to California law. So I should have said that initially. But the equity in the business or the goodwill in the business before marriage is separate property. After the marriage, if there's not a prenuptial agreement in place and the business continues to grow, the spouse that's not part of the business could actually accrue an interest in the business. So if you're really wanting to protect that business going forward, then what you would need a prenuptial agreement, at the start, that would basically say, hey, look, our businesses, our incomes are separate property going forward. And that would preclude sort of the amalgamation of the community property interest. The idea behind the community property interest growing in a closely held business is, well, the proprietor of the business is working, and they're giving away part of their selves to keep this business going, so the other spouse is not seeing them as frequently. And so they get a benefit, the spouse that's not running the business should get a benefit for the other spouse's business, because that spouse is away from the home. The other spouse is presumably handling the chores and details and things of that nature. So that's why there is sort of a community property interest that could grow that way. I think a prenuptial agreement is the best way to deal with that.
That's excellent. That's good advice. Okay, so what about, this is another question, and I know LJ provided this to me, but this is another question that we're seeing from employers. How to prevent an employee's divorce from impacting your business?
Yeah, that's a good question. I mean, I could see where this would come up. If the employee, I'm assuming the employee doesn't have any ownership, or they,
No, not at all.
Okay, so if the employee is having a tough go of it, they're going to be emotionally, drained. It's going to impact their work, their life, like it would everyone else. And, I think the owner, or the employer has to be cognizant of this. Hopefully there's an open dialogue. Some employees don't tell you everything that's going on in their life, but, if there is, I think the employer has to be cognizant of that. Similar as, if someone maybe had COVID, right? They're going to need some downtime. And I think that that's going to be something that you're going to have to be cognizant of if you're an employer. Now, it's not going to really impact your business other than that employee maybe not being, fully available, and working as hard as they used to. But I mean, there's not going to be any repercussions for the business other than the employee's real effort.
Okay. So here's one of the other questions that came through. This is one person, I won't mention names or anything, but she has a number of rental properties that were inherited prior to the marriage. and they've been married for about 7, 8 years, or she's looking at going through divorce. Will she be able to keep those, or does she have to split them with the husband? How would that work?
Well, as a general premise in California, inheritances are always separate property. So it doesn't matter if it happened before the marriage, during the marriage, it's separate property. The problem that people run into, for instance, if you're talking about something fungible like cash, so you got cash from your mother when she passed away, you put that into a community bank account. Well, it's still separate property, but now you've commingled it in a community bank account. Now, if you're talking about real property like real estate, it's much harder to commingle. So I would say that she has a very strong argument that is all separate property all the way through.
Okay, perfect. Okay, perfect.
The problem with real estate, real quick, though, Steve, is you inherit a property, and then, oh well, this property needs to be needs a new kitchen. So then you use community funds to repair the kitchen, and now you've created a separate property asset and a community property interest in that separate property asset. So that's where it gets a little convoluted for some people.
Oh wow! Oh wow! That's great. Okay, so the next one is a question of somebody who's considering divorce. The nice thing about my viewers line is, it doesn't matter who it is; it's nobody knows. Right. Husband has she has an IRA, and she's considering divorce. She's the money earner, and she's likely to have to split things, provide alimony and all that stuff. How does it work if she's splitting her IRA or 401k? Will it be a tax impact? How does that work in divorce?
Well, the way it's typically done is there's a qualified domestic relations order that's after the tallies are done and you're determined what you want to divide. Say, for instance, in California, you have 200,000 in a 401k. Okay. And all of that was contributed during the marriage. So husband's entitled to 100,000, wife is entitled to 100,000. So how do you divide that? There's a qualified domestic relations order where you file with the court. The court says, okay, granted. And that under that order, you can separate that without any sort of tax ramifications. If you don't file that and you don't go through that step and you separate, well, yeah, you're going to have early withdrawals and all kinds of tax penalties and things if you just do it on your own. You've got to have that qualified domestic relations order in place, filed with the court, which is really easy to get. I mean, it's just a step that a lot of people don't consider. It's kind of like, the wealthy parties that know what they're doing, they get along well and they say, okay, well, you know what, I'll keep the house here. I'll take out $1 million from my IRA and you can have it today. And then they start realizing, okay, well, there's a lot of tax problems because they did that. They didn't follow that qualified domestic relations order. But in short, if you go through the protocol, there's no tax implications as long as you roll it over into another IRA for the other person.
Perfect. You know what, Brent, I want to thank you for being here today. We've come to the end of our time. Now, if somebody wants to get a hold of you at your firm at Kaspar and Lugai, how do they go about doing that?
Yeah, the best way to get it is just through our website, www.kasparlugai.com, and it'll direct you to our phone lines and our team.
Hey, I want to thank you for being here, Brent. The information you provide is invaluable to our listeners, and I know they appreciate it because we're going to get some feedback here real soon. So thank you very, very much. And you know what? I'm looking forward to seeing you in the future and possibly having you on again.
Absolutely, Steve. It was my pleasure.
All right. Have a good one. Be safe, be healthy. We'll see you. Bye-bye. Now, thank you. Screwed that up. Hey, Cameron, we're going to redo that ending or that outro. Everybody, that was Brent Kaspers from Kaspar and Lugai. By the way, if you need help looking to understand what's going on with divorce, or you just, want a second opinion, you know what, look them up, get a hold of them. And you know what, there's no reason why you can't go to the website at savingwithsteve.us and rinse and repeat this segment over and over again so you can get the information, the pearls of wisdom you need to make your life or your transition a little bit easier. Now, you're going to want to stick with us. We're going to be right back. We're going to be talking about estate planning 101, and then we got Steve Sless right after that. So hold on. We'll be back in a moment. Okay, perfect. So all you got to do right now is select Cameron. A little that last segment will probably need to get edited out, but all in all, it's really good, and we want to keep as much of it as we possibly can. So any of the portions were I went, obviously cut those out, please, please, please. And next, I'm going to be talking about estate planning 101. And let's see. Oh, wait a second. Yeah, estate planning 101. And here we go. All righty. So 5, 4, 3, 2, 1. Cameron, we're in segment 3. Hey, welcome back to the Saving with Steve show, where we talk about the ins and outs of money. I'm going to be going through a bunch of stuff that is very important. Okay. Number 1, estate planning 101. What are the documents that you actually need to make your life work? Okay. First things first. You know what? In being in the business that I'm in as a financial consultant, I've seen many times, at least once or twice a year, maybe more, where we have family members of clients or family members that are clients come to us for help with their relatives. And the first ask for help typically comes when they're beginning to take over one of their relatives, bills, expenses, because, they're 85, 86, they've started having medical issues or losing faculties. And I mean, that's just a fact of life. But if you're getting involved with helping somebody out, meaning paying their bills, making sure they get to the doctors, making sure you have to have all the right documents for that. In order to do that, you need to know where those documents are. So the very first step is to start making a list of where things like a birth certificate is, a marriage certificate, your wills and trusts, okay? Where are the bank accounts? I mean, just where are they located, okay? Then you want to make sure you have your financial advisor's name and phone number, your accountant's name and phone number, your will and trust attorney's name and phone number. Why? Because if somebody needs something, they can typically go to one of those professionals and they will likely have it. Now, that's the first step. The next step is to accumulate those documents. So bank accounts, insurance policies, investment accounts, all of those things need to be listed on where somebody can find them. A location where somebody that will be able to be your advocate has the ability to get into your passwords. Okay. Now, once you have those, you know what? You want to make sure that they're in a safe place, or you provide them to somebody who might be your durable power of attorney over your healthcare, over your finances, or that successor trustee. So if you pass away or become incapacitated, they can take over the management of your trust. Now, one of the things that I recommend, if you're looking at a last will and testament, okay, you want to make sure you have this document, especially if you have kids under the age of 18, because it's going to tell who raises those kids, how they're raised, when they get money. Okay. You get a list of, your personal property in there and who it goes to. All right. On your 401ks, you want to make sure you have the beneficiaries. This is very important because in a 401k, they have a primary beneficiary, which is the primary person that gets all your stuff, and a contingent beneficiary, which is the person who gets your stuff after that primary beneficiary is not in the picture anymore. And you know what? The best way to mess up things is to not have that done or have the wrong person. You know what? I just came into my office today, talked to an accounting professional, and somebody that person used to go out with almost 3 decades ago had listed her as the primary beneficiary as opposed to his kids to receive everything. Isn't that nuts? And guess what? She got a call from the gentleman's daughter, and the gentleman's daughter says, "Hey, I need to get this information," the whole shot. In fact, the person I was talking to didn't even know that hadn't changed. Okay. So obviously she plans to abdicate her role and say, "Hey, look, this guy owed me this much money. I want that. After that, you can have everything else." So it'll make it very, very easy. But you know what? If you have a 401k, IRA, or insurance policy, or life insurance policy, or a pension, those things are irrevocable when somebody passes away. So if there's no beneficiary for that pension, okay, guess what? Nobody gets it. If the ex-wife is on that pension as opposed to the new wife, guess what? The ex-wife gets it, not the new wife. Same thing for the life insurance, same thing for the 401k, the IRA, the annuities. So you want to make sure your beneficiaries are correct. In fact, I just met with somebody yesterday that we're going to have to change all the beneficiaries because they just have one person, but don't have the child sitting as the contingent. Power of attorneys. This is really important. Hey, I'm in the state of California. If you don't have a power of attorney and are not able to make healthcare or financial decisions on your behalf, and you don't have one, guess who gets to do it? The state of California. And if you love the way they're managed in the state of California, hey, no problems. But if you don't, you probably want to have somebody who loves you, who is open to making those decisions to help handle your finances, pay your taxes if you're not able to. You also have a power of attorney over your healthcare. Now, the reality, if you get carted in an ambulance, it's going to be the doctor and the insurance company is going to making your healthcare decisions for the ones you love. Not a good thing. And if you're incapacitated, it could be the state of California along with your insurance companies and the doctors. Now, if you have a power of attorney over health and you happen to be brought into a crummy hospital, the person who's the power of attorney can have you moved to a good hospital. They can fight with the insurance companies, the doctors, on getting you the best possible treatment to save your life. Okay. So you want to make sure you have those documents now, and you want to make sure that means you want to have a trust, a will, a power of attorney, a durable power of attorney. Now, other things that are really important, your proof of identity, such as your social security, marriage, birth, divorce certificates, prenuptial agreements, that also needs to be in a place that people get to. Okay. So these are some things that you're going to need to have to make your life easy. If you'd like a complete list, you're going to want to go to the savingwithsteve.us website, look for this episode. This is episode number 65. And you know what? There will be a link there where you can get an estate planning checklist. Okay. So, hey, look, that's it for this segment. I want to thank you for being here today. We've got another segment coming up. We got Steve Sless. He's the reverse mortgage expert. He's going to teach people how they can leverage or maximize the equity in their real estate. So stick with us. We're going to be right back with some Steve Sless. Cameron, okay. Cameron, that was segment number 3. I'm going to do the intro for Steve Sless, and then you're just going to be editing in the rest. Okay. All right. So here we go. Okay. Cameron, I'm just going to do the intro so you can kick it really quick here. So we're walking into segment 4 with Steve Sless. So here we go. Hello, welcome back to the Saving with Steve show. Again, we're talking about the ins and outs of money. All the replays are available at www.savingwithsteve.us. If you're enjoying the stories of helpful information and insight on Saving with Steve, I encourage you to go to our Spotify, our YouTube, our Google Play channels so you never miss an episode. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, AM/FM 247. All these networks are dedicated to empowering you to uplift your spirit, live a life of personal and financial freedom, and solve all those problems. Let me read that. Let me do that again, Cameron. All these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of financial and personal freedom. Hey, you can follow us on Facebook at Saving with Steve Sexton. Join the Insiders Club. Get guest gifts, backstage stuff. It's really cool. And, take your experience to the next level. Now, our next up is Steve Sless. Okay. Now, here's the biggest thing. Many seniors are worried about making things happen. Their next day last when they're in trial. It's one of the biggest concerns everybody has. You know what Steve's been able to do is he's been able to help people or educate people on how to get the most out of the equity in their home, especially now since the value's gone up. We've seen things where people can't qualify for long-term care because of COVID issues, the whole shot. So Steve Sless is going to help us through. Steve has nearly 20 years of mortgage industry experience, including 13 years devoted to reverse mortgage. He's one of the few reverse mortgage professionals to have earned the CLTC, the Certified Long-Term Care designation, demonstrating that he has acquired the knowledge to educate the industry. Steve becoming a leader in the industry by educating people through seminars, videos, the media. Steve is the go-to house wealth source for 2021, according to Yahoo Finance. In fact, he was named the reverse mortgage game changer by Yahoo Finance. So Steve, I want to welcome you to the show. Thank you for being here. Thank you for being this expert that we're calling on today.
Likewise. Thank you for having me, Steve. Great to be with you.
Well, you know what? I just want to say this. Once we let people know that you were coming on the show, our viewer line, or I want to say a line or email, just started blowing up. And you know what? But before we jump into this, I know you were in regular mortgages for a few years and you've been into reverse mortgages for about 15. Tell us your little story. Why did you transition into the reverse mortgage world?
Yeah, I got into the mortgage business, about 20 years ago now, and spent the first few years of my mortgage career doing what most mortgage professionals do, and that's cash out refinances, purchases. At that point, there was a big subprime market, and we were originating those loans as well. And I had to make a big decision, 2007, 2008, when the housing bubble came crashing down. What was I going to do? Right at that point, the company that I worked for was not able to originate FHA loans. And that left me really unable to perform the business that I've come to know and love. And I had to make a very strategic decision at that point. And I had started researching reverse mortgages at the time, but I was in my young 20s and I had a lot of doubts that I would be able to engage with an older demographic. But through my research and through my studying, Steve, what I found was the reverse mortgage is such an incredible tool to protect and prolong one's retirement. And I jumped in head first. And, 15 years later, I haven't looked back. In retrospect, it's the best career decision that I've ever made. I've dedicated myself to reverse mortgages and helping folks to live a better and more comfortable retirement ever since. And very grateful for making that decision a while back.
Well, you know what? I think it's a noble service you provide. The key here is what I really like when looking at your videos is you educate people. A lot of people are concerned because they've been doing the same thing for decades, and a reverse mortgage is something new. And I think one of the things is, if you can, I have a lot of questions, but I would love for you just to briefly talk about how does a reverse mortgage work?
Yeah, Steve, what we teach more than anything else is the concept of integrating housing wealth into a comprehensive financial plan, right? Steve, for 74% of folks that are 62 years old, they're already short of their retirement income needs. However, a new report came out about a couple months ago. There is over $9 trillion in untapped equity of folks 62 and older in America. Over $9 trillion. And so that money is dead equity. It's not working for those folks. It's not doing it. It's just sitting there dormant. What we teach, Steve, is how to incorporate that equity strategically and tax efficiently with a reverse mortgage loan, and use those funds, which is in most cases the client's largest asset. Use them proactively instead of reactively. And the result is we're able to extend their finances. We're able to extend the longevity of their investment portfolios. We're able to allow them to enjoy a better and more comfortable retirement. And we're able to make their money last longer because we're leveraging what is their largest asset, and that's the equity in their home.
Perfect. But okay, so when it comes to a reverse mortgage, everybody's trying to figure out, hey, will it work for me? Am I a good candidate for this? So help us, expand on that so people can say, hey, well, am I fit? Does it work? What? I know you just have to be 62, but other than that, how's it a good fit?
There's two different types of reverse mortgage. There's a HECM, a home equity conversion mortgage. Those are government insured reverse mortgage loans. And I would say probably 95% of every reverse mortgage originated today is a HECM government insured product. There's also now, Steve, been a lot of innovation on the proprietary reverse mortgage side. So private lenders, non-government insured, are now rolling out reverse mortgage products. And most of these loans are jumbo reverse mortgages. They are for a higher net worth clientele. We can lend on a jumbo reverse mortgage up to $3 million in cash for homes valued all the way up to $10 million. Reverse mortgages work like this. You got to be at least 60 plus. You got to own your home, and you got to have roughly 50% equity. And so for folks that have a mortgage, one of the biggest benefits is we can replace their traditional mortgage with a reverse mortgage and eliminate the mandatory mortgage payment requirement. And so by doing that, we're able to extend their cash flow. We're able to free up cash flow, free up finances. And we can also, if they have enough equity to qualify, we can release funds to them from the equity in the home. And that can be done in a variety of ways. Folks can choose to take a 10-year payout, which is basically your home sends you a check every month until the funds are exhausted. There's also a term payout where you just say, hey, Steve, I need X amount of dollars and I need it for X amount of period of time, 5 years, 10 years, 15, so on and so forth. You can take a lump sum from your home equity, or the most effective strategy is you can take out a reverse mortgage line of credit. And a reverse mortgage line of credit is very different than a traditional line of credit, Steve. One, they're federally insured. They can never be suspended, reduced, or frozen, irregardless of what the economy does or what the market does.
That's big.
These lines of credit also have a guaranteed growth rate attached to them. And so you're able to borrow more of your home equity every year the line of credit is in place.
Okay,
For most
so
of our clients,
I got a question on that. Let me ask you this question here. So when you talk about, because this is one of the questions my viewer asks, is, they know that your line of credit will grow by a certain interest rate each year. Is it based off the equity that you have that is available to be withdrawn, and that portion grows, providing you haven't take money out from that? Or
the line of credit has a set growth rate. And what's important to point out too is this is a growth rate. It's not interest. So think of it as a credit card where your limit is being increased each year.
Okay,
the
good.
growth rate on the line of credit is 0.5% over the interest rate on the loan. So today's interest rates on reverse mortgages are about 2.5–3%. Figure the growth rate is going to be 3 to 3.5% on any unused portion of the line of credit. Okay. So as you draw funds out, obviously you don't get any growth on the funds that you're pooling, but any funds that you leave and let sit in the line of credit, we call it a standby line of credit, because you can just park it, put it in reserve, put it on standby. Those funds grow over time, and you just treat it no different than any traditional line of credit, and you draw from it if and when you need it.
That's wonderful. Okay, so I think one of the big things there is that it can't be taken away, it can't be reduced. So that means if once the foreclosures and all that stuff comes to bear and the market values go down, even though somebody got a reverse mortgage today, say their equity line is 200,000 and maybe their house is only worth 200,000, they can't take that away. It's not like a credit card where they can reduce your credit limit.
Exactly. And think back, Steve, to 08, 09, when the housing market crashed. You had a lot of these folks were over 60. They had traditional home equity lines of credit. They thought they had access to $100,000, $200,000 or more in some cases. And the bank came back and said, you know what? Yeah, we're not going to let you borrow that money anymore. And that wrecked a lot of people's retirement plan. That cannot happen with reverse mortgages because the line of credit is federally insured. It is guaranteed. You're also, Steve, able to borrow on today's market value. We're in a booming housing economy right now. I mean, there's bidding wars on homes. In some cases, homes don't even make the market, and there's a bidding war already. And so values are soaring. You can take out a reverse mortgage line of credit today and lock in today's value. You and I were talking about this before the show came on. It's in all likelihood, values are going to at least level off, if not go down. So too is the market, the economy. And so it's a great hedge against future market corrections, being able to lock that line of credit in and do it at today's value, not future values, and know that that value is guaranteed.
Steve, that's wonderful. Hey, look, you know what? This is great information. We're going to take a quick break. Guys, stick with us. We got to pay some bills. We'll be right back with more Steve Sless. Perfect. That's excellent, Steve.
Thanks, Steve.
Okay.
Great questions. I mean,
Well, they're both yours and everybody's emailed in. I've got so many here. I
So
can't wait to turn people over to you so they can start sending them to you.
I
Um,
appreciate it.
Hey, Cameron, we're going to move into segment 2 with Steve Sless. So here we go. We're going to go ahead and get started. Hey, welcome back to the Saving with Steve show. Hey, I want to truly thank you for tuning in and appreciate you letting your friends, family, and associates know about the show. All the replays are available here at savingwithsteve.us. If you're enjoying the stories of helpful information, insight on Saving with Steve, then I encourage you to subscribe to our YouTube channel, Apple Play, and Spotify channel. Hey, check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, Las Vegas TV Network. All these networks are dedicated to empowering you to live a life of financial and personal freedom. Also, you can follow us at Facebook at Saving with Steve Sexton if you'd like to some more financial tips. So here we come back with Steve Sless. We've got a slew of questions here, so we're just going to get started. You know what? There's pros and cons to anything. So let's just hit you. Hey, what's the downside of a reverse mortgage? What's the con side?
I think it really starts in the beginning. It's all about suitability. And so when somebody comes to us, Steve, and they say, hey, I'm interested in learning about a reverse mortgage, there's first an educational journey that we need to take them on. We're also trying to figure out ourselves, are they suitable? Right. So if you come to us and say, well, the first question we ask, Steve, is how long do you want to live in the home for? If somebody were to say 3 years, 4 years, it's probably not a great fit. And so there would be a downside there. I think the barrier to entry, the cost to take out a reverse mortgage loan is probably too great at that point if you're only going to be in the house for a few years. This is a long-term solution to living a comfortable retirement and doing so aging in place in the comfort of your own home. Look, another downside is, and it's not necessarily a downside, it really depends on what your viewpoint of this is. Reverse mortgages are loans that have negative amortization, which means that if you make no payments, and Steve, you can treat a reverse mortgage no different than a traditional mortgage. If you want to make payments, you certainly have the right to be able to do so. But a lot of folks choose not to make monthly mortgage payments. And if you choose not to make a monthly mortgage payment, your balance each month is going to increase. A lot of folks are fearful of that. They're fearful of their balance increasing. What we teach, Steve, is, look, the home is a low growth potential asset. Right? If you have a financial advisor that is managing your money and that money is well diversified, it's in the right markets, it's invested well, chances are that advisor is yielding you, 6 to 10% returns right now. Historically, the home appreciates at 1 to 4% per year. And so we teach, use the home equity first instead of using the retirement assets first. And combine all of your assets. But a lot of folks are a little hesitant because they're fearful of their balance rising over time. And look, at that point, you have to become educated. You got to become empowered. And ultimately, you got to make the best and most astute financial decision for you.
Mm-hmm. No, that's great. Now, let's clear up some of the myths and misinformation. Okay. And I actually already know because I have experience with some of these, but our listeners don't.
Sure.
Now, can somebody lose their house with a reverse mortgage?
You cannot lose your house because you have a reverse mortgage. That's a huge misconception. And if we have time, Steve, a quick backstory. So prior to 2015, if you were over 62, you had equity in your home and you had a pulse, you had blood pumping through your body, you could get a reverse mortgage. Mm-hmm. There was no credit qualifications. There was no income qualifications. And so the result was you had a lot of folks that were already destitute. They had already run out of money and they were using the reverse mortgage as a last resort. The reverse mortgage just prolonged the inevitable. It prolonged their ability to remain in the home, but it was inevitable. They were going to lose their home because they just couldn't afford it. They didn't have enough income to pay the taxes and the insurance. Those are the qualifications of the reverse mortgage. You got to pay your homeowner's insurance, you got to pay your property taxes, and you got to maintain the home. If you default on any of those requirements, you will lose your home. But that's no different. Look, if you have a regular mortgage or even no mortgage at all, Steve, and you don't pay your taxes, you're going to get foreclosed on, you're going to lose your home. But by having a reverse mortgage, you cannot lose your home simply by having the loan.
Mm-hmm. Okay, perfect. Now, Here's another question. And I also know the answer to this because I've experienced it before way back in '08. What happens if, like, for example, we've got the market screaming up right now with the housing market, everybody wants to buy and all the supply line issues. Hey, I get a reverse mortgage. It's a $600,000 reverse mortgage. And you know what? The market goes down next week or whatever in a year. And my house is actually worth $300,000 and I pass away. What's going to happen? You know, what are the options my heirs have?
It's a great question. So all reverse mortgages are non-recourse loans. Non-recourse means there's no recourse and there's no debt passed to your heirs or your estate that they have to come out of pocket and pay. So at the time of your death, your heirs are going to have the option to buy the house for 95% of the appraised value at the time. They can also walk away. If there's more owed on the reverse mortgage than what the home is worth, they can walk away and the non-recourse component kicks in. The HECM reverse mortgages have government reverse mortgage insurance on them. That insurance policy that is on all these reverse mortgages will settle the debt. It's almost like gap insurance for your car, Steve. Right? You total your car, you owe $20,000. The insurance company cuts you a check for $15,000. That $5,000 gap is covered. Reverse mortgages work the same way. So you can have the peace of mind of knowing that you can take a reverse mortgage out. And if at some point there is a market correction and you do owe more than what the value of the home is at the time of death, your heirs can simply walk away, or they have the option to buy it back at 95% of the value.
Yeah, one of the reasons why I asked that is I wanted to share the story for everybody. Back in 2008, one of my clients who had a reverse mortgage passed away, and the reverse mortgage was actually like $450,000. And after 2008, the house value, when they appraised it, was $195,000. When the heirs were looking at just dumping it, saying, "Hey, fine," but when I explained to them, I said, "You can get a house for $195,000 and let it grow." And they went, "Oh my!" And basically, they bought the house for $195 and sold it a few years later for twice that much. So they were, you know what, in a wonderful position when that occurred, and it's a great option. Now, you know what? One of the questions I do have is this. You know what? In this world, you have divorces. Okay. And this question has come up. I probably have 30 of these questions. Divorce rates in California are at 50%. If it's a second divorce and they're older than 55, it's at 72%. What's the effect of reverse mortgage and somebody receiving income if there's I'm going to say a gray hair or silver hair divorce?
I love that question, Steve. So we have a partnership. My firm has a partnership with the IDFA, the Institute for Divorce Financial Analysts. We're working with financial analysts that specialize in senior divorce, and we're helping them use reverse mortgage loans to navigate their clients, financial woes while they're going through these divorces. And so we're using the reverse mortgage as a tool to divide the marital home and use that equity for one person to remain in the home while the other leaves the home. We're also using it, Steve. We just had a case like this not too long ago where the couple sold their home for $300,000. They both put down $150,000 on two separate $300,000 homes. And they bought those homes with a reverse mortgage. You can actually use a reverse mortgage loan, Steve, to purchase a home in retirement. Most folks don't even realize that. Most realtors don't realize that. So it's a very effective strategy, and it's one that we are deploying quite a bit as we work through the Institute for Divorce Financial Analysts to help their clients, ease the financial difficulties of gray or silver divorce.
You know what? I just want to add this. Over the years, there's a number of clients that have come to me, and they've come to me because they're trying to find a way to make retirement work, and they've overspent or overhelped a child or something like that. And we've gotten in contact with a reverse mortgage specialist for the primary reason. In one case, the couple actually took out a jumbo reverse mortgage, but they were able to eliminate their current mortgage payment, which is a little over $2,500, which was the gap they needed to make their retirement work for the rest of their life. And then they had an equity line left over that they were going to use in case some health issues ramped up on them. and they were just going to let that grow until it was there. And you know what? That was probably 12 years ago, and they let that thing grow. I think it's like, I mean, like a little over $500,000, and they started tapping into it because of home care needs. So they're going to have more than enough to do it, and they're so thankful that, you know, I said, hey, go look at considering getting a reverse mortgage because this is what you need. So they were able to prolong their life, have the retirement that they want, and now being able to take care of somebody just because they looked at what you talked about strategically, you know what, tapping into that asset, which is their, you know, house equity.
Yeah. And look, Steve, I mean, there's multiple ways. I mean, look, the bottom line is there's over $9 trillion of senior housing wealth that is not being used right now. Reverse mortgage is just one way to use it. There's other options. There's traditional mortgages. There's traditional home equity lines of credit. However, the difference with the reverse mortgage is there's no mandatory payment obligation. So if you're in your 60s or you're in your 70s and you're looking to take funds from the equity in your home, would you rather do it and not have to pay those funds back, not have a mandatory mortgage payment, or would you rather be saddled with a 15, 20, or 30-year mortgage payment and have to come out of pocket with that payment every month and until you're in your 90s in some cases? And so oftentimes it makes more sense to take out a reverse mortgage. But again, it's all about education, and it's about weighing the options, and what works for some may not work for others. And that's where we come in to help them figure that out.
Yeah. And one last thing before, one of the things that I have found as of recent, a lot of people are in situations like in states like California, Illinois, New York, where the cost of living's got pretty expensive. And their only options are to sell and downsize or move out of state, and sometimes moving out of state, or they look at getting that reverse mortgage just to free up that money that they need to make their life work. So, you know what, I think what you do is noble. I think what you're doing right now with educating everybody is very, very important and is needed. And that said, you know what, we're about to wrap up our segment with you. Could you tell us how people can get a hold of you, how they can go get your videos so they can get educated and, you know what, get the help they're looking for?
Absolutely. I appreciate the opportunity. So my firm's name is the Stephen J. Sless Group. It's the Stephen J. Sless Group. We are the reverse mortgage division for primary residential mortgage. We have branches in all 50 states throughout the country. You can reach us by phone. Our number is 410-814-7575. It's 410-814-7575, or online at the Sless Group, the Sless, SLESS group.com. On YouTube is where all our videos are as well. And we have a lot of educational content on there. If you just go on YouTube and search the Stephen J. Sless Group, you'll pull up our content. If you get there, I'd appreciate if you like the videos. And if you want to be notified when we put out more content, just subscribe and hit the bell at the top. And every time we release a new video, you'll get to know.
Hey folks, the first thing of learning anything new is getting education. They've got a great resource at the slessgroup.com. So you want to go out there and look at it. If you're looking to get a hold of Steve, definitely go to that website. Steve, I want to thank you for joining us. Hey, stay safe, stay healthy. And you know what? We have a lot more questions to get answered. So we're probably going to have to circle back in a few months and have you back on. Is that okay?
I'd love to. I appreciate the opportunity. You're doing great work, Steve. I appreciate it.
Appreciate it, Steve. I've heard too many Steves today, and it's a great name you have. So, hey, we'll look forward to seeing you next time. Thank you so much for sticking with us today.
Thank you.
All right.
Bye-bye.
Hey, everybody, that was Steve Sless. You want to stick with us? We're going to be right back. Perfect. Okay. All you got to do is sign off and we're good to go. Thanks, Steve.
Great. All right, Steve. Appreciate it.
Got it. Hey, Cameron, that was Steve Sless. We're going to be moving into segment 3. And you know what? Here we go. I'm going to wait about 10 seconds for you. All righty. So, hey, welcome back to the show. That was Steve Sless. He was talking to us about how to use our home equity to make sure we can have the life that we want in retirement. So, you know what? If you'd like to get more information on Steve Sless, or go to the slessgroup.com. They're a wonderful operation, a lot of education. First step with any financial decision is getting education. Okay. Without education, you can't ask good questions, which means you can't make prudent, informed decisions. So life's all about making prudent, informed decisions. And this is all about the ins and outs of money. And that's one way to do it. So go to that website if you'd like more money. Now, this segment, I'm going to be talking about what's been going on. And I wanted to start this with a story about somebody I worked with way back in April 2007 and have continued to work with him. And he allowed me to share his story. See, this gentleman and his wife were referred to me back in April of 2007. Yeah, it was a long time ago. But in April of 2007, he and his wife came in, and you know what you don't know about him is he worked in the startup and IPO industry. He wasn't, a money guy that did IPOs, but he helped build companies. And he was, in the midst of his third IPO that was going to get launched. The first two, kind of faltered after it got launched. One was just before, 9/11, in which case, the whole world for the tech industry went down. Since then, he had saved a bunch of money, and now he was looking to get this, multi $10 million payout, providing he stuck with the company for 6 months after the IPO. Now, the IPO was going to issue in November of 2007. When he came into my office, I asked him about his industry, and he spent 20 minutes talking to me about how fickle the IPO startup industry was and how very few actually make it. A lot like all these people want to be stars and musicians. Not everybody makes it. So when we were talking, he also had accumulated a little over $2.5 million. And you know what? I said, hey, look, if we're going to do retirement planning and tax planning, let's do them separately, because you told me how finicky the IPO world, and what if something happens and you know what, that IPO goes down? And he actually agreed with that. So we started talking about his $2.5 million. And I said to him, you know what happens if we do have that downturn, your IPO goes away and the market goes down by 30 or 40%? Would you be able to stay retired, or would you have to go back to work? And he said, well, I'd probably lose $1 million and I would have to go back to work. And I said, is that something you want to do? And he said, no. I said, okay, what we need to do is we need to create a plan where we can reduce and eliminate the risk you have, and then make sure that you're getting the rate of return you need to live the retirement dream that you have. And he said, okay. And that okay look was one of those things like your dad says when he thinks you're full of it. You know what I'm talking about? And you know what? I went through how you go about doing that. And he and his wife, or he actually said, hey, thank you very much. Appreciate the time, and got up and left. I didn't think I'd ever see him again. But he called about 3 weeks later, and he told me, he goes, Steve, when you said that, it was an aha moment for me. In fact, I got chills. In fact, I got scared. That's the reason why I left. I said, well, help me understand what you're thinking here. He says, well, look, I was there in 2000. In fact, I had more money then than I do have now. And I continued with the risk, thinking things are going to be okay. And I lost almost 70% of what I had. I saw friends who had retired a couple years early that had millions of dollars, only to have 1 or 2 million because of what happened, because they didn't reduce their risk. And the reality is they didn't realize that they didn't want to go back to work. And a lot of them did. And you know what? Or they downsized, changed their lifestyle. And he goes, and I don't want to do any of that. But my concern is I don't know how to protect things and create my income, because I've been spending my world accumulating risk. And I said, hey, don't worry. You're like every person who's looking to retire. Okay. So all we really need to do is we need to create a prevention strategy where we retain what you have, grow it with a reasonable rate of return so you can live the life you want in retirement, but protect it. And we spent about 2 months educating him. We brought in real estate experts, money managers. I educated him on safe products and things like that. And in July, we got everything set in place. And you know what? November hit, I get this phone call. He goes, Steve, my IPO is worth $25 million. He was all excited. You know what? In February, as you know, the world fell in. And the valuation of that stock went to next to nothing. I was supposed to meet him at the end of April. I met him at the end of April, but the stock was worthless. He got a notice that he's going to get 2 months worth of salary. And that was going to be about it. They still plan to retire because of the plan that we put in place. Now, his valuation, his portfolio went up to about $2.8 million before everything went to hits. But you know what? It only lost a couple $100,000. So he still had about 2.6 million. Now, for him, that still was enabled them to create the income they need in retirement. In fact, the very first word he said, he just says, you know what? I'm very grateful. And I said, why? He goes, you either have a crystal ball or what? I said, no, I don't have a crystal ball. If I did, it wouldn't be here. Neither would you. But here's the thing that we did. All we did is some good planning. We recognized that there is a life transition here. And that life transition went from I'm working to I'm no longer working. And all we really did is we made it real simple. And I'll make it real simple for you. Think of your investments as red, blue, green. Okay. Red is Wall Street, stocks, bonds, mutual funds. Anything that has risk, stocks, bonds, ETFs, they're going to go up and down with the market, 30% up, 30% down. It's just the way it goes. If you're looking at the blue, you're looking at investments that are not correlated to the stock market. So if the stock market drives, guess what? This has a little bit, but not a lot of loss. And it has a predictable income, which people like. Okay. It adds stability to your portfolio. And then you have the green section, which is protected items like from banks and insurance companies that they have protection. Now, when you're looking at banks, you're looking at CDs and things like that don't earn much, but you always use equity linked CDs. Okay. You definitely want to talk to your financial advisor about that if you're interested in those things. And then you have annuities. You know what? You have fixed annuities and you have fixed index annuities. Okay. So for example, with a fixed annuity, it's a lot like a CD, you get a guaranteed interest rate, but we have a fixed index annuity. It grows with the index as opposed to a fixed interest rate. So if you have a 10% upside, you could get a 7% increase and it locks in that growth. So if you started with 100, you have 107. And if the next year the market crashes, you still have $107,000, which is wonderful. Now, the key here is you take a look at this. You say, hey, how much do I want in the red section, the risk section? Hey, I want 30%. I want 40% in the predictable income section. And I want 30% in the guaranteed section. It's all going to combine to generate a certain rate of return so you can live the life you want. But let's take a look at it when it hits the market. So for example, if you have $1 million there and the market goes down by 30%, you're only dropping by 30% of 30, which is a 10% drop over the whole piece. And if you look at the critical income and say you're getting 7% there, hey, I lost 10, but I gained 2. So I have a net loss of about 8. Wow, 8% is a lot easier to recover from because I only need about 9% to recover as opposed to 30 where I'm going to need 50% recovering. A lot of people out there are listening, and what they're listening to is they're saying, hey, you know what? I'm still working because the impact of 2008. So the key here is this. Everybody looks at risk differently. Some people love the reward they get from taking on risk, while others are proactively taking steps and putting measures in place. So if things don't go as planned, they don't take as big as a hit. Okay. So the key here is this. If you're a couple of years to 5 years away from retirement, it's important to look at ways to reduce and eliminate risk. Because quite frankly, there's a lot of advisors out there that say, hey, don't worry. It's only a paper loss. It's only a loss if you sell. Well, the issue comes with this. If you're in the first couple of years before, a couple of years after retiring, 5 years before retiring, and you take that significant hit, you might not have enough time for your portfolio to grow before you have to start taking income from it. So it really doesn't give you that opportunity to grow so you can access your savings in that short period of time. So think of those things. You know what? A lot of people don't understand real estate, and that's the reason why they have everything correlated to the market. You know what? There's ways you can invest in real estate. You can do it through a rental property. Okay. You can do it through a real estate investment trust. You can do it through a Delaware statutory trust. You can also do it through a TIC. The key here is you want to find a specialist who understands those that can educate you. So again, the message here is this. You want to make sure that you have some sort of diversification with your portfolio. You want to make sure you're reducing and eliminate risk. You want to sit down with your advisor to go about doing that. Now, that's all for this segment. I hope it gave you some great advice to make a difference in your life. Now, you want to stick with us. We've got a great segment coming up with Danny Artach. We'll be right back.